Good morning and welcome to the Killik & Co market update. As expected, Theresa May's Brexit deal was voted down by MPs on Tuesday, and it went down as one of the worst defeats in parliamentary history, with lots and lots of members of her own party voting against her. The situation from here is still very, very unclear, and it's really difficult to work out what's going to happen. We're expecting Theresa May to come out with some kind of plan B early next week, but at the moment it does look as though plan B will just be an attempt to negotiate a slightly better deal than what we have at the moment. So really difficult to know what's going to happen here. I don't believe we have any more clarity than we had last week, and at the moment it's very difficult indeed to invest in UK equities. Because of that, we've been having a look at the performance of the FTSE 100 over the longer term. So here's a chart showing what the index has done over the last 20 years. And what really is quite sad is that the index is at the same place that it was at 19 years ago. So have a look at where it was in the year 2000, and today it's very much at the same level. So very disappointing to note what the long-term performance of this index has been. It's definitely true to say that many big stock market gains have been made across the world, but most of those have been overseas. And I think it really is quite sad to note how disappointing the FTSE 100 has been over the longer term. Now having a look at some of the Chinese data that's come out recently, there have been quite a few headlines about how Chinese data has been looking rather weak, so we thought we'd have a look at a few notable data points. One of those is the so-called PMI survey. So PMI stands for Purchasing Managers Index, and it's a survey that asks a number of different managers whether they think their business is expanding or contracting. All of those results are accumulated into one score between 0 and 100, and any score above 50 is thought to mean the economy is expanding. Any score below is thought to mean the economy is contracting. So here we have a chart showing the Chinese PMI numbers over the last couple of years. And as you can see, there has been a slight decline over the last few months. And in fact, last month that value did drop below 50. And that to some people does mean the economy is contracting. So that's what's caused a bit of concern. But I think it is important to note that these numbers are dominated by the manufacturing business. At the moment, that is huge in China, and it has been responsible for a large amount of their growth over the last few years. But at the moment, China is very much trying to move away from that, and it wants to become more of a service-based economy. At the moment, the services industry in China is relatively small, but it is expanding. And if you were to break out these PMI numbers and have a look at just the services on their own, that would give a slightly more rosy picture. So I don't think these numbers are all as bad as they look on the surface. Something else to look at is how much younger generations get paid in relation to the average wage. Now, if you have younger generations getting paid more than the average, that does imply that economic progress is being made. So that's a number that we have been looking at recently. Here's a chart that gives you those data points for a couple of different countries. And as you can see, actually, the numbers here are quite negative for both the US and the UK. So in the US, 25 to 29-year-olds actually earn 11.5% less than the national average wage. So that does imply that economic progress is not really being made in those countries. China, on the other hand, 25 to 29-year-olds are making 16.5% more than the national average. So that really does imply there that progress is being made. So in our view, not all the data coming out of China at the moment is looking negative. And last of all, we've been having a look at the gold price. Now, gold has historically been viewed as a safe haven, and it does tend to do well when equity markets are volatile. So have a look at the chart here. You can see there has been a very clear increase in the gold price as equity markets have been quite volatile since the end of last year. Now, looking back a bit further than that, you can see gold has not done particularly well. One reason is that equity markets were doing well at the time and there didn't feel like much of a need for safe havens. And the other reason is that gold doesn't pay an income. So in an environment where interest rates are starting to rise, that makes assets like gold that don't pay an income seem relatively less attractive. So that's why gold has had a slightly negative long-term track record over the last 5 or so years. But I think it is starting to pick up now that equity markets are becoming more volatile. So I think it is important to keep an eye on the gold price at the moment. Now, moving on to the week ahead, we've got a few large UK companies reporting, a couple of major miners. We've got BHP Billiton and Antofagasta, and we've also got results coming up from Vodafone. That's it from us. Have a great weekend, and we'll see you next Friday.